Expectations today, look, can we outperform the US, or we have underperformed some of the global leads? How do you see us going today?
Generally, we do tend to underperform the US, but it is going to be a fantastic day on the markets. The SPY's pointing up about 1.5%. And if we have a look at the areas which are going to move the most violently upwards, it's going to be those areas which have been sold down heavily throughout the month of May. And if we have a look from the beginning of May, the worst performing areas have been the materials, energies, and the industrial sectors. These areas have lost more than 11%, and that's where we're really going to see some of the big moves come through. Stocks like Aquarius Platinum, which have lost 50% since the beginning of May, as well as Coalspur, Bathurst Resources. They've lost around about 40%. So expecting some violent moves in those miners, and of course lots of short covering going on. We're expecting to see every single sector trading higher today, but those defensives are going to be the underperformers. We're going to see the miners outperforming, the financials outperforming as well. If we have a look at BHP, a fantastic performance overnight, up by 4.7% in London, up by 3.3% in the US. Rio Tinto, very similar, up by about 4.5% in both London as well as the US. So watch those big miners today.
Very much predicated on the idea of stimulus. So we have had obviously QE1, QE2. We've seen what it does in terms of global equities, global commodities. Here in Australia, I mean, do we get a similar impact? Where do we tend to see the bounces, if at all?
It's quite interesting because at this point in time, we know what quantitative easing does in terms of the commodities markets and in terms of the share markets. We saw QE1 in the US, and that was from November 2008 to June 2010, and in that period it was really commodities which outperformed. We saw things like copper up by a massive 63%, nickel up by 72% in that period, but it was actually equities which underperformed. The Australian share market in that time was only up by 7%, whereas the US market was up by 6%, and that's really because we were coming back off the back of Lehman Brothers and the concerns around that. QE2 was quite interesting as well, because if we have a look at QE2, that went from November 2010 to June 2011, and there we didn't see quite a violent as reaction. We saw things like copper prices up by around about 11%, the US market also up by about 11%, but that's because speculation around QE2 started much earlier. It started in around about September 2010. So if we have a look from September 2010, we saw copper up by 22%. We saw the US market up by about 22%, but the Australian market was only up by 2.5%. And one of the things that we saw in QE2 was the Australian market massively underperformed, and that was really because of the effect of currency. We saw the US dollar weaken. That was great news for US company earnings, but of course that high Australian dollar, a big headwind for Australian companies.
Does that threaten to be a similar issue? We've got it about 99 US cents. Some expectations we could hit parity with the greenback if we get a strong jobs number, and if we do get stimulus, as you say, we have historically seen it go into some of these risk currencies. Does that have the potential again to stifle a big bounce in equities?
It's all about this race to the base, and if we have a look at quantitative easing, it's not just the US that's looking at quantitative easing. We have the Bank of England meeting tonight. They'll probably be looking at more quantitative easing, and the Japanese have already indicated that they want a weak yen as well. So really it depends on the size of the quantitative easing and from whereabouts in the world we get it. If we see something massive coming out of Europe, well, that may overshadow that move that we see in the US currency, and in fact we may see the US currency strengthen, which could end up having a positive influence on Australian companies.
Interesting comments from ECB President Mario Draghi saying the ECB is ready to act if need be, but it seems still very much keeping the ball in the court of the politicians. He doesn't want to be, he doesn't want the ECB to be the stopgap measure, the fallback, I suppose, player in all of this. So how definite do you see, or what are the chances, do you think, of not just a rate cut at the next meeting, but some sort of stimulus from the ECB?
I think with a rate cut, it's just a matter of time. So it's just a matter of when the ECB is going to bite the bullet to cut rates over in Europe. But of course, around stimulus, that's a whole nother ball game, and it's really about the Germans. They do seem to be caving in, and I guess that was one of the positive things that we saw overnight, reports that they are more open to bailout of the Spanish banks. But really, we'll be watching Germany in that very close regard, because if we have a look at who's going to pay for a lot of the problems in Europe, it's probably going to be Germany.
And what about from the perspective of the US? Obviously, the market very much hoping to see something beyond an extension of Operation Twist. Do you see it happening? happening, and what about a time frame? There has been some suggestions that Ben Bernanke might not want to wait too long because then it gets caught up in a US presidential election cycle.
We've had QE1, QE2 and Operation Twist, and I guess Operation Twist hasn't had as big an impact on risk assets because really we haven't seen an expansion of the Fed's balance sheet there. We've just seen some of the longer dated interest rates coming down, and that's being funded by some of the shorter dated maturities on those bonds. So what the market's expecting isn't another Operation Twist. It's actually expecting more quantitative easing, and that's why tonight's going to be important, where we do see Bernanke in that Congress briefing, and then the market's going to be watching the 19th and the 20th of June, which of course is the FOMC meeting. So all eyes, all hopes on that. And the other big risk, of course, we haven't talked about today is the 17th of June, which is the Greek elections, and it's amazing. We started off March focusing on Greece, and we're ending focusing in on all of Europe as well as the US.
So wrapping it all together and keeping in mind the fact that particularly during QE2 we did underperform in terms of equities, where should investors maybe be looking to position themselves to get, I suppose, some of the return that we have seen in terms of stimulus?
Well, I think the first thing to be aware of is the currency fluctuations, because quantitative easing has a massive dilutionary effect in terms of the US dollar. So knowing that, and knowing that commodity prices usually perform well, I guess it's going to be commodities which once again outperform if we do see more quantitative easing, but that needs to be hedged against the currency effects. So things like copper do extremely well, nickel prices, zinc as well as tin.